We got massively oversold at the beginning of October. We caught our first buy signal on October 4th, and then we got one of our best buy signals that we get inside of our quantitative work on October 10th. And you could see it coming at the end of September. Breadth and momentum really started to deteriorate as we got into the beginning of the month. I think a lot of people made the mistake, and they were kind of scratching their heads wondering, why is this market going down in October when the economic data and the earnings seem to be tracking very nicely according to what we saw. But there were some fundamental issues inside of the market, mostly around tech and financials, that gave people pause when you talk about the exogenous events that could be out there with regard to trade and interest rates.
What about the buyback blackout? How much did that matter?
Well, it does matter a lot when you got a lot of these big companies that have massive billion-dollar buybacks going on, and it doesn't give the underpinning to the market. But the other thing
that happens every quarter.
It does. But the other thing you have to remember, which I think is more important than companies just being in a blackout of that, is how the market is structured fundamentally these days. Lots of program trading, lots of ETFs. And I know we talk about this a lot, but when markets start trading lower or trading higher, a lot of the programs kick in. And also on the redemption notifications years ago, as a mutual fund, a manager would go pick one or two stocks that he could raise cash. Now ETFs have to sell across the board.
We talked about that a couple of days ago, and I got widely poo-pooed. Keith, thank you. Welcome back anytime, by the way. Rene, let's go to you, because you don't believe that what we saw the last couple of days, not including today and yesterday, I mean, the downturn was the mark of something bigger, but you do believe it marks a shift in how we should look at investing. How and why?
You know, I think that everybody has been waiting for a big correction in this market. And so while I don't believe it's the end of the bull market, it's not the beginning of a bear market, but it definitely is creating a shift. So I'm more interested right now in having more defensive issues. Growth stocks have been really building and growing this market. But, you know, this market is a 6 to 12 month forward looking beast. And so it's signaling to me that we're going to have impressed or expressed different kinds of profitability, that is going to be depressed. And so we've had a nice pickup this year because of the tax cuts. That made it easy for them to be profitable. So next year, I don't think that the profitability is going to be as high. So I'm more interested in adding some more defensive, value-oriented stocks, and taking into consideration that we've got higher interest rates, tighter job market, tariffs. There are certain sectors that you want to be in and certain sectors that you don't want to be in.
Yeah, Caleb, it sounds like from the notes that we've got on your positions that you're also feeling a little bit cautious and not quite ready to dive back in.
Yeah, I think the way we're approaching this is we're looking for the secular winners that are trading at cheaper valuations. So I'll give you two names. Sherwin-Williams, which over the past 5 years has traded between 18 times and 36 times earnings. It's now trading at 18 times earnings. Valero, another name that's trading at 8 times forward. And if you look at Valero, since 1977, the U.S. has not built a major integrated downstream refinery. And so over that time period, Valero stock is up over 1,700%. And so to be able to buy that name at 8.5 times forward earnings is, we think, a buying opportunity. But when October sells off as it has, November often follows with volatility as well. Then we have better seasonality going into December and January.
Caleb, Valero, really, it's a refiner, but it's kind of a bet on the consumer because you drive more, you refine more oil. Sherwin-Williams, a paint company, that's directly on the consumer. Yeah. Buy a house, paint the walls. Are you still optimistic on the consumer? Are those bets specifically on the consumer, or are they more, these are individual stocks, we like their valuations, we like their fundamentals. It's not necessarily a broader market call.
It's both, but if you look at the data today, so ADP data overshot, ECI came in higher, so we're seeing wages pick up, the highest wage growth in 10 years. That's going to be tough on some, input costs for profit margins for some corporations. But if you're, selling paint or you're refining crude, it's probably a good thing for you.
So, Rick, I wanted to ask you about the dollar. It's had a 2% gain on the month, and it's sort of quietly here been marching higher every single day. What levels are you watching, and what are you hearing about whether that can continue? It's been such a big theme of pain for earnings this season.
No, and the pain probably gets worse because dollar liquidity will continue to be an issue. It will get lower as the Fed continues to tighten. And debt around the world, of course, is at quite lofty levels. So it is something to contend with. And it isn't only emerging markets. There is a scramble. The swaps markets, the forward markets that continue to weigh on balance sheets of European banks, it will reverse a bit because of the disparity between the economies of the U.S. and the economies of Europe. That divergence actually will relieve some of the purchases and dollar swap needs of overseas investors. I think it's easy. I think it's marching to 100. It's currently hovering just above 97. I challenge anyone who has any technical interest to look at any chart more than 5 years long, and it certainly looks like 100 is going to be like a magnet. One quick thing on the fixed income market. You know, the curve is a little steeper than it was, but just to give you an idea how little Treasuries paid attention to a lot of the volatility, we're currently trading 339 in a 30-year. Its high yield close of 4 years was the 5th of October at 340. We're less than a basis point away from that.
Joining us, Rene Nourse, Caleb Silsby, Keith the Genius Bliss, and Rick Santelli. Thank you all very much. Appreciate it.